Thank you for joining me. In my last presentation, I said that if the Fed starts tightening, asset prices would fall. Well, as you look at your 401k statements, it is already apparent that 2022 has been rather cruel. But several of you have asked me, what has happened to bonds? They were supposed to provide some stability in my portfolio during these bad times. But bonds have fared just as poorly as stocks. And you have asked me, what in the world is going on? In fact, the Wall Street Journal reports that this has been the worst bond market since 1841. Now, I can't verify if that is accurate, but it is already apparent that this has been a very awful bond market. So in this presentation, I provide a visual explanation for the drastic drop in bond prices. I'll start with the problem. This graph shows the decline in stocks and bonds since the beginning of 2022. The orange line is stocks, measured by this S&P 500 index, and the blue line represents bonds measured by the Barclays Bond Index. We can see that in the beginning of May, both stocks and bonds have fallen by closely the same percentage, although the path to this decline has been different. The bond decline was far smoother than the stock decline, but this shows that bonds did nothing to counterweight the decline in stocks. In the past, bonds would have not fallen as far as stocks have, as they did here. To understand what is going on, we have to understand the inverse relationship between bond prices and interest rates. The par value of a bond is the amount the bond issuer promises to pay the bondholder at the maturity date of the bond. Bonds are usually issued with a $1,000 par value. There are three variables that determine a bond's present value or price. First, the coupon payment made each period, which we denote here as C. Next, the number of coupon payments, denoted as N in this presentation. And finally, the interest rate, which is denoted as R. Now, many of you have already seen this present value formula. It is usually the first thing that is taught in most finance, economics, and accounting classes. Two important things to see are that first, when interest rates rise, bond prices will fall. And second, the inverse relationship between bond prices and interest rates is nonlinear. We will visually see this nonlinear relationship later. This chart plots the target federal funds rate from September 2018 to the present. As I mentioned in my last presentation, this is the overnight rate that banks charge each other. It is also the Federal Reserve's policy tool. The federal funds rates influences other interest rates, such as mortgage rates, corporate bond rates, treasury bond rates, and municipal bond rates. Ultimately, when the Fed fund rates increases, bond prices and equity prices will fall. Starting in September 2018, the Fed slowly raised the federal funds rate to 2.5%. This caused over a 20% drop in the equity markets by December 2018. Powerful investors and hedge fund managers complained, and the Federal Reserve gradually capitulated and lowered the federal funds rate. Then, about 7 months later, COVID hit, and the federal funds rate went down to 0.25% or 25 basis points. This caused both equity and bond prices to soar. The S&P 500 doubled from March 2020 to the end of 2021. This was the first time in recorded history that equity prices were divorced from their fundamentals. Over the past year, inflation has roiled due to these dual mandates. The Fed now has no choice but to raise the federal funds rate. So far, it has increased the target rate from 0.25% to 1%. And even this 1% is still historically low. Yet, it is this small 75 or 0.75% increase that has caused a collapse in the bond market. To get a comparison, I show the chart of the 10-year Treasury note, ranging from 1962 to the present. While this rate is influenced by the federal funds rate, it is a 10-year rate and not an overnight rate like the federal funds rate. In the 1970s, inflation raged. When President Carter appointed Paul Volcker as the Federal Reserve Chairman in August 1979, there was an increase from 9% to 16% in this interest rate, or a total of a 7% increase. This seems far more severe than the recent increase from 0.5% to 2.5%. The orange bracket represents the increase after 1979, and the green bracket represents the recent one. On the right side of this slide, these two brackets are compared. What is amazing is that the 7% increase of the 1970s did far less damage to the bond market than the recent 2% increase. We will find out the reason in the next slide. This chart plots the present value formula that I presented earlier. I have rewritten it at the top of this slide. This plot gives a visualization of the nonlinear relationship between bond prices and interest rate. The curve has a convex shape where the first derivative is negative and the second derivative is positive. It is this convexity that is behind the magnitude of this most recent collapse in the bond market. To see this, let's look at the effects of a sequence of 1% increases in the interest rate. Now, going from 0% to 1% creates a $468 loss. Going from 1% to 2% creates a $360 loss, which is less than the loss going from 0% to 1%. Each additional 1% increase in the interest rate creates a smaller loss. So, in the late 1970s, we went from a 9% rate to a 16% rate, and recently we've gone from a 0.5 to a 2.5% increase. But the visual shows here that the loss of going from 0.5% to 2.5% is far greater than the loss of going from 9% to 16%. And it is because the Federal Reserve started to raise interest rates 3 months ago when they were already close to zero that has created all of this havoc. So when money is cheap, or in other words, interest rates are close to zero, bad things happen if interest rates have to rise like they did recently. Many pundits, including The Economist magazine, claim that we're at the end of cheap money. I don't know if this is true. Again, I think forecasting interest rates like forecasting inflation rates is a fool's errand. And I certainly wouldn't bank on the idea that we're at the end of cheap money. However, there are factors in favor of the end of cheap money. The Fed is committed to downsizing its balance sheet. If inflation continues to be a problem, then it'll be hard to go back to cheap money. And there are high debt levels around the world, and many claim that higher interest rates are necessary to sustain these high debt levels. However, there are factors that also lead to the resumption of cheap money. First, there are current demographic trends where birth rates are exceedingly low and our population continues to age, and this will reduce the demand for borrowing. Despite the high debt levels, there also continues to be a glut of savings in cash. Presently, there is $4.5 trillion in money market funds. Finally, if the Fed tightening sends us into another recession, there is no evidence that this current Fed has the resolve and the tenacity to stay the course. To conclude, I know that you all like your 401ks to increase in value. But I think that forcing interest rates to be close to zero is the wrong way to do this. Rather, the fundamentals behind the securities you own should be the source of growth. I believe there are dangers to extremely low interest rates. If another crisis occurs, there is little gunpowder left to provide more Federal Reserve monetary stimulus. Forcing interest rates to zero misprices assets and leads to a misallocation of financing. Finally, it takes away the ability to save safely while getting ahead of inflation. I do believe that holding some cash can be advantageous. First, if new opportunities arise, you have a source of funds to buy these opportunities without the need to sell other good opportunities. Having cash is a type of option. Also, holding enough cash to pay for a year's worth of expenses is insurance when unexpected catastrophes arise, such as a job loss. But with higher inflation, the cost of holding cash is now much higher. I ask you to consider not being tempted into panic selling when asset prices fall. You might end up selling low. Most important, I believe it is important always to stay diversified. Thank you for joining me.